And joining me on the podcast right now, and of course, live on video, it's Paul Hill. It's full-time everything at the moment, isn't it? It seems like all the headlines, Paul, is about financial stuff, which is very important. And of course, it's moving the markets, it's volatility. We had the Fed out yesterday, and while this goes out, of course, we'll have the UK sort of Bank of England interest rate probably going up by quarter percentage point as well as the Fed. But it's moving the markets, and let's just focus on that yesterday. People were talking, that they may not even, push interest rates up, or they may go for 50 basis points. And I personally thought, I don't think they'd go for 50 because they're putting out fires on an individual basis. And some of that has been created by them, indirectly in a way. And so I think they're going to have to be aware of that, of the damage they're creating. And of course, the lag effect. They have no idea of the lag effect of what they're doing. Have they gone too far already? And what's your thoughts on what's happening at the moment?
Oh, I mean, yeah, there's been absolutely masses of sort of macro stuff over the last 2.5 weeks, and it's sort of like picked me up from the sort of being run over by a truck, I think, and most of the other investors in terms of the banking crisis and all the sort of like, it was still sort of like we're still fighting inflation. But yeah, just coming back to the Fed, I think the market actually was sort of like it was either going to be not for the Fed, predicting the Fed was either going to do nothing or go 25 basis points. And I think Jerome Powell decided to opt for the path of least resistance because that's where the market was pointing them. It was going to be sort of 80% or 90% nailed on that he was going to increase it to sort of 5%. But where we are, I mean, after recording it sort of like, 24 hours afterwards, we had the Silicon Valley Bank collapse over the weekend. And then we had obviously Signature Bank go, we had the bail-in of the bonds on Credit Suisse. We then had the bail under, effectively the buy under of Credit Suisse by UBS. And now we've obviously still got the problems with the First Republic out in the States. And there's a number of other sort of like, well, they're still large regional banks, actually. I mean, they're not small, we're talking about. So the way I sort of picture all this is that we've still got a long way to go, unfortunately, with this banking movie. And my instinct is saying we're going to be playing whack-a-mole. And I think where the regulators, they're just praying that we're not going to have a systemic crisis, which I think is probably true. But we're still going to have a number of instances, and therefore they're going to be data dependent. And you heard that from Jerome Powell last night saying we're not finished with the inflation fight because it came in hotter in February than they were anticipating, particularly month on month, core stripping out energy and food. The same thing happened with the UK inflation yesterday. It was up, CPI was over 10%. So that's sticky. And as you rightly say, it looks as though Andrew Bailey is going to tick up interest rates. And the ECB pushed up its interest rates last week by 0.5 percentage point. So that inflation fight is definitely not won yet. But they're not sure how much, as you rightly put, the lagging effects of the monetary tightening they've already done, which is considerable. But now adding the banking crisis on, and I've heard a lot of sort of well-educated sort of like capital markets experts saying it's going to put a drag on GDP of roughly around about 0.5%, but nobody frankly knows. All I would say is that my estimate or my probability that I'm putting on for a recession or possibly even a hard recession in the second half in the US and in Europe is now much higher than it was before. And I actually think the way the bond market is positioning, i.e. with a, sort of like inverted yield curve, but at the front end, it's becoming less inverted. That's saying it's going to be a recession, but the stock market's still saying actually with valuations at 17, 18 times PE in the US and S&P, I think it's overvalued, and I actually think it's coming down. But it doesn't mean, what's your view in terms of small caps and large caps? Because we've seen a lot of pain in small caps. And I don't know about you, but there's lots of really good opportunities there.
Yeah, there is. And I just want to say, you talked about the inversion of the yield curve there, and I literally got a weekly chart in front of me. In fact, I'll send it across. We'll put it on the thing here. But you can't deny this. I mean, it is the most recent 10 recessions have been predicted by this. And if you go back to, I got a weekly chart here dating from 1980s. Okay. And this inverted in 1988, 1989, recessions have followed. Happened again in the dot-com bubble. It went down to minus 0.2 recession. Great financial crash happened again, went down to minus 0.2. Where are we now? We're at minus 0.4. and it went down to minus whole 1 percentage point.
Yeah.
Now, the accuracy of that is amazing. And I thought Jeremy Hunt standing up the budget saying, I don't see a technical recession this year. And I thought, mate, the inverted yield curve is a better predictor than you are, okay? And I think it's going to happen. So
too right.
Yeah, and I just think I think it's pretty much nailed on. And like I said, they were talking last night about what Jerome Powell does and what Andrew Bailey does. That's part of it. But now you've got, of course, the banks a little bit worried here, and they're putting out fires on a piecemeal basis,
daily basis.
Daily basis, and it's going to slow down lending. Make them more cautious. It'll be harder to get loans, and in fact, loans are expensive anyway. So that's going to have an inevitable effect and slow down the economy. And so I think we are headed in for a recession. And as far as I'm concerned, I'm seeing, like you, lots of small micro cap stocks that got good tech, IP, all that, and they've got some cash as well. But it's just timing. It's like, if you're prepared to hold on and maybe have a bit more pain, get in now. But for me, I'm looking around with lots on the watch list, and I want to see some kind of commerciality happening, some kind of uptrend happening in the share price, because, like I said, I think it'll be over the next year or so. I think it'll be a hard market. We'll have inflation figures coming in like we've had yesterday, where it'll be above or hotter than expected. Then the market will have a bit of a rollover, and that'll stoke the central banks. And you get this up and down, and then you get some inflation data that's better. And we know inflation doesn't go straight down. It sticks around. You have unpredictable readings coming out, which will shake the markets a bit. So I think this will happen until we get like 2 or maybe 3 inflation reading points that are going down. You can see a trend happening. I don't think the market will rally consistently. And so that's why part of it, apart from looking at small caps and micro caps, about 40% of my portfolio now, I'm heading for sort of good bigger companies with dividends and reinvest in them for a while. I'll sit on them. I don't mind if they drop down a bit, but I think for the next year or so, it's going to be hard. I really do. But still, if you have the patience, there are some good bargains out there. Absolutely.
Yeah. I'm with. I think it's a great strategy. It's that sort of being prepared to ambush the stock market when it takes a dive. Because if we are both right, and there is going to be a mild or even semi-hard recession towards the back end of this year, then it's no way are the indices going up, they're coming down. The valuations are too stretched, particularly where the cost of capital for companies is that much harder, not only obviously on the on the sovereign debt curves, but more importantly, you're going to get the widening of credit spreads, which is going to increase the corporate borrowing levels, or essentially the borrowing costs, of a lot of companies. And I would certainly advise, investors to tread carefully in those interest rate sensitive, those high cost of capital areas. Obviously, we talked about sort of avoiding companies with excessive debt, but even that, the house builders have come up with some really quite interesting, statements. They're all saying the same thing, that basically that, mortgages, sort of like are a tough place to be. And the banks are essentially asking for much higher deposit levels for first-time buyers. So you saw that from Countrywide or Countryside Properties this morning. I mean, they basically said at the high end, where you have people who are affluent who can pay with cash, then their properties are still moving, prices are okay. But where at the lower end, in that first-time buyers, they're now having to putting, rather than putting, sort of like a 10% or 15%, they're having to put a much bigger, and that's really slowed it up as well. And the appetite for corporates to want to basically take on loans from say the banks has diminished, because they obviously the costs as well. So anything which is interest rate sensitive is tough. And also, it was quite interesting. One of the car retailers came out with this statement this morning. I think it was Pendragon or somebody like that. And they basically said it was all fine, but the problem was that they're a lagging indicator, because actually what's happening in the States with autos is that the inventory levels of cars on the parking lot is really increasing, and the incentives, and what happens in the States comes over in the UK in 3 to 6 months. So I would definitely steer clear of interest rate sensitive. And another area, I mean, that the consumer's an area that I would be cautious on, and I've basically, I've accepted my mea culpa on Purplebricks and on Boohoo, and I sold both positions about 2 weeks ago. After Silicon Valley Bank blew up, I then thought, right, okay, this is a game changer, because it's significantly going to increase the probability of a recession, and it's much harder to turn around both of those businesses in very much consumer discretionary areas. Interest rate sensitive, obviously, for Purplebricks, and obviously, fast fashion, with Boohoo, and I just thought, actually, yeah, I mean, they're good, they could well do it, and Purplebricks has actually got a sort of like potential takeover, but I just thought, right, okay, this is time to cut it, because the fundamentals just don't look as attractive as they were sort of like, when I originally bought. And you just got to accept that. You've got to move on. I mean, I've made, I sort of say I've lost sort of like, 75% on Purplebricks and 80% on Boohoo. So big losses, but sometimes you just got to basically take it and just say, I made a mistake, I got it wrong. And that's one of the third that do go wrong when you come to sort of like, select these type of businesses.
Yeah. So in those areas, I mean, at the moment, what I'm doing is I will literally not go above 3% in anything total portfolio exposure at the moment. So, for example, MJ Gleeson, which is low cost housing, it's a decent business. It's fallen by 50% in the last 18 months or 12 months. They pay a dividend, but like I said, I'm just under 3% total portfolio value on that, and unless something disastrous goes wrong, I'm happy to sit for a while and just collect dividends, reinvest them, and I won't increase my exposure to them at all. I think at Assos I got 2%. I'm sort of, in fact, I was in profit in Assos. It's gone down a little bit, and a little bit down, and Gleeson a little bit down, but it's sort of like not. I mean, maybe high single digit percentage-wise down, but yeah.
Sounds as though you're sizing your positions well there.
Yeah,
you're sort of like
because I mean,
not taking too much risk.
Yeah, because I see it as a almost like a multi-month or multi-year almost opportunity, and I don't think we're going to have the easy time we had. This is why you're right there. You have to change when situations change, and we are in a lot different environment than we were like 4 years ago. Whereas interest rates were flat on the floor, and finance was easy to come by, placings were easily done. And that led to, microcap stocks, or the stocks I call hope high potential stocks, rallying very strongly. They're not going to have an easy ride of it. So you've got to make sure. Do you know this market makes you become a better investor completely? You have to get better, or you'll get wiped out. Full stop.
Yes.
And literally you've got to be so careful, and you don't have to jump in like before. I mean, in the bull market, you jump in, a stock could go up by like 50-60% microcaps easy in a day, and so you had to make a decision quickly and jump in. But if you made a mistake, it didn't matter too much because everything was going up anyway. But now it's not, it's the other way around. So you have to be very careful, and you can afford to take your time and research. And that's why I've literally got a rigid plan in place about exposure levels, and I literally will only average up, I won't average down, because you can do that in a bull market. It's a dip, but it's not in a bear market. It's a downtrend, and that can last for a long time. So I'm very, very careful. I've still got about 41% cash, and safe at the moment. About 40% of my stocks are dividend paying stocks, so I see a bit of growth in as well coming forward. So
that sounds a pretty sensible strategy. I mean, I would say, if you look just over the last 3 years since the pandemic, we had the lockdowns in 2020. Anything which was basically a stay-at-home stock went to the moon, or a COVID testing stock did really, really well. They got burnt in 2020, effectively late 2021, by the time the vaccines had been implemented. We then had that same year. We was offset by the boom in all things inflation related, so oil and gas, mining, house builders. Anything like that, holidays, travel stocks, leisure, but as people sort of went out and partied, they had an absolute. So 2022 was the high watermark for most of those companies, particularly obviously oil and gas, and anything that is essentially, got, as an inflation play. But this 2023 is going to be a year whereby you're really going to have to distinguish between those companies with competitive moats, with IPR, and with pricing power. So when inflation comes down, but their costs are still staying sticky, they can effectively protect those margins through essentially, continued price increases in an overall deflationary environment, but also sort of quite aggressive cost cutting. And that is quite an interesting mix. And what I think that when you look at the sort of the classic stocks that fit into that, is the other factor. You've got a 12-factor model or something you look at, The other one I would strongly suggest all investors have a good look at is properly the gross margin percentage. Because if you've got a high gross margin, that implies that offensively you've got a lot of IPR, a lot of pricing power. And if you get growth, a lot of that will flex through your operating leverage into your bottom line. And that goes to what we've been talking about, a lot of the sort of tech stocks, software, and healthcare. So those would be the areas that I would concentrate on going forward. And I think there's some quite good babies in the bathwater that have been sold off that I am watching. I mean, at the moment, I've taken a big cap strategy because I've been sitting on my cash from Crestchick. Other than I have actually bought 2 large cap healthcare stocks recently. I've mentioned to you Pfizer, and after we last spoke, because I got the money from Crestchick, I then moved it up to a proper position. And just to let everybody know, Pfizer's about a $225 billion big pharma company doing the vaccines, and I actually think it's got a good pipeline, which is underappreciated. It's actually just bought, or in the process of buying, Seagen, which is an antibody drug conjugate company, which effectively is a really targeted cancer-busting drug that they're hoping to take from 2 billion sales currently to roughly around about 10 by the end of the decade. And as I say, I think Pfizer, even though it's got some patent expiries from 2025, I still think its underlying business can grow by 6% per annum. And if you put that through the operating leverage of a gross margin of over 80%, you can easily see 15, 16% EPS growth every single year. So if you put it on a 15 times PE ratio, you get a price, sort of like, I think I remember it was about $50, $60 a share compared to 40 at the moment. So it looks like a no-brainer to me. And the other one in a very similar one I've just bought, which is a new position, is Roche out in Switzerland, which is another similar size company, 225 billion Swiss francs, which is slightly more than Pfizer. But what I really like about those guys, they've got a good mix between leading edge diagnostics, which is about 30% of the business, and the big pharma, which is largely into sort of like immunotherapies, into cancer, but also does into sort of multiple sclerosis and ophthalmology and stuff like that. They've just got world-class working position, both trading at good valuations. Pfizer's on about 10 or 11 times 2024, PE, with a really strong balance sheet. I mean, you've got to remember, these were winners in COVID and just built up their balance sheets. We shed loads of cash, which they got from it. And Roche likewise is on about sort of like 13 times PE for world-leading businesses that should be able to grow top line mid-single digits, pay a good 3% dividend yield, dead rock solid balance sheet. And because that operating leverage, and we've just talked about that 80% operating leverage, they'll hit 15, 12, 15, and maybe 18%, EPS growth over the next decade. I mean, what's not to like about that? It just it's a sleep at night stock.
Yeah, exactly. And I think that's the position, largely upping the micro cap, and literally going for higher quality business, the paying dividends is the way forward. Because I don't think, honestly, the next year or so is a time where the micro cap index is going to have a blowout. You'll have 1 or 2 stocks doing very well. Of course you will. It's like, for example, U Group, it's one of the best performers.
Yes, exactly. I saw that.
Yeah, one of the companies like that, the top line growth in energy sector has gone really well. You'll have those blowout stocks at that, but they will be an anomaly. They won't be, they run the market. The entire index won't go up. And the AIM all share index won't go up. You get the outperformance, of course. But I think generally it's going to be a hard market for micro cap stocks. So you've got to select very carefully. And I think when you've got that, I mean, if you look at hope high potential stocks or micro cap stocks, they've got to have cash, plenty of cash, and they've got to have a runway to get to, through this turbulent time, to get the sort of commerciality if they're not already there. And so, and in the meantime, I think the best returns I just see this going up and down for a while with these inflation figures coming out, getting too hot, some of them be better, and then all of a sudden it'll just be a very volatile market. And I think the only sure way to get decent returns is like solid companies paying dividends, and you're not going to, obviously get rich off that, but at least you're not losing money. And that's it's a good way forward.
Everybody's been losing money, haven't they? I mean,
I know, sick of it. And that's how the market, and that's how it translates in the market. You get people literally switching off. Money outflow happens. You get any new money inflow happening, and that's it is just sentiment, isn't it? A lot of it is sentiment. It's
I'll tell you two small caps that I've got on my watch list sort of stuff that I've interviewed just recently. First of all, Verici, which I interviewed the CEO as an operating update yesterday. These guys have got we're talking about gross margins, 85% gross margins on their sort of effectively their next generation immunodiagnostics for kidney transplant tests. And they're actually firing on all cylinders. They're not generating too much revenue yet, but that's going to start to come through strongly at the back end of this year. They've got sort of like $10 million of cash on their balance sheets. They've got a runway until mid-2024, if not longer. And their lead test, their Tutivia sort of like post-operation test, is 3 times more accurate than the next
Yeah.
best test out there. And this is a market already worth, I mean, the biggest player makes about $200 million a year just on sort of kidney transplant tests. So this is, I mean, when I spoke to Sarah, this is a multi-hundred million sort of market, addressable market just in the US, etc. And they're getting really good reception from their, from the doctors and from the clinics that are actually using it. Now, how much upside is the question? Now, the shares I saw are roughly trading about 7p. Singers have got the last estimate. They've got a price target of 79. I mean, I know it's you can't bank it, but hey, that's a 10 bagger potentially. If their Singers are right, that's a potential 10, and you can see why, because it's got world leading diagnostics technology in an area that is devoid of a good technology. And it's 3 times better than it currently is. There's an established market. So let's just put yourself, you are a flipping doctor, and you're going to spend like, $400,000 putting a kidney into somebody, to implant a kidney into a new person. Are you really going to sort of penny pinch and say, oh, I'm not going to spend $2,500, whatever it is, on dollars on this test, because, it's too expensive or whatever? Of course, you're going to do it simply because if it can improve the matching, it can improve the treatment of the patient, the outcome, and can extend the life of that kidney in that patient and reduce the dialysis cost, which is about nearly $100,000 or $90,000 a year. I mean, the economics are perfect. Plus, I mean, it's 3 times more, say, accurate or precise at predicting whether, or should we say it's sort of positive, to determine whether there is actually a problem, with the acceptance of a kidney by that transplant patient. I mean, it's a no-brainer. As I say, the market has just turned off to these type of stocks, but it's got huge IPR, and it's got a real good sort of like, lots of patents behind it. So, hey, there's no doubt about it. It's more risky than a Pfizer or a, basically a Roche, because obviously it's not paying dividends yet. But those are the kind of opportunities.
They are, yeah.
Really
I talked about Verici on my sort of, webinar with my sort of membership club, and I said, this is on my watch list because it's got that IP, it's got a huge upside, they've got cash. I said, at the moment, it's out of favor of the market, but that's to your advantage. You can get, this is the kind of stock, if it does what it's expected to do, like I said, it could be a 10 bagger because it's sold off so heavily. And it rallied the other day. You often see at the bottom, you get these odd rallies on almost no news, and it went up like 16% the other day, and then it's come back down. And so this volatility, is it at the bottom? I don't know, but the way I'd play this, for example, I'm watching it, and I've got alerts in the chart on that company all the time, and they're often going off, but I keep watching it. It keeps reminding me to revisit the stock. And then if I'm going to get in, I will literally take on these highly volatile microcap stocks. I won't take anything more than 1% because that keeps my eye in the game. And like I said, you've got a couple of these, a handful of these, it won't hurt you too much if they go down. But when they start to move, you will know about it, and then you can sort of average up, because like I said, they've got a runway to commerciality pretty much, and they've got IP, and the market is large, and it's almost like looking at it, it's a no-brainer. But in this market, it can be very painful because they're out of favor. But like I said, that's but therein lies the upside. It's out of favor. They're 10 million market cap. It's like, what?
No, I mean, hey, when it starts, well, hopefully when it starts going up, you'll generate massive alpha. There's no doubt about it. In your portfolio, when you do a size position like that. One thing it has struggled on, which is totally not its fault, is that because if you just cast sort of your memory back to 2020, I think it was late 2020 when it listed IPO, sort of like November, October time, it was spun out of Renalytics, okay, and it was given away for effectively. The originals, there's lots of original shares which were given to Renalytics shareholders, so they got it for free, and then it obviously raised some money from fresh capital, etc. But I can't remember exactly, but probably round about sort of 60% of the shares who were effectively the shareholders were given these ones free. What's actually happened, other than Renalytics and with Mount Sinai, who are also still a shareholder, all these other fund managers who got it, as say, for free, they've actually just tidied up their portfolio over the last year and got rid of it. They've just basically just sold it, not because they don't like it. They've just basically sold it, or they don't think it's, just to tidy it, just to say, okay, I got it as part of Renalytics, or I got it effectively originally from EKF Diagnostics. And that's what it suffered. You just had basically no sort of like, rational, sort of selling on the back of it. What was interesting actually when I spoke to Sarah, and I'd strongly recommend if people who are interested to have a look at the video, we chatted right at the end about strategic options, and she is really open to having a look at all ways to significantly increase shareholder value. So do not be surprised if you see this share move positive at some point in time, if they come up with, particularly with sort of like people like Christopher Mills, who are a shareholder as well. So
well, you can read by the RNSs now that they're literally accelerating the path to commerciality, and you realize in a bull market you can take a bit more time, but when you're in a bear market and there's a lot of pressure and people say, come on, get on with things, you have to get on with it, and they have that, and they can do that, But I know a video I just watched actually of yours yesterday. Oh, it was the day before. Was Tony Gott from? Oh yeah,
I was just going to move on to Saietta. Yeah, go on, go for it. What do you think?
So I haven't watched the Verici. We'll watch that, but Tony Gott, and he comes across. I've spoken to him before with Kiss before together, executive chairman, but he's got a heck of a background. Tony Gott. I looked at him on the website, and he's worked for a lot of big Rolls Royce, I think, cars and that stuff in the UK. But he's got a heck of a background. But what I quite liked about that is he seemed an honest, genuine guy. And like, to me, like Saietta came to the market with 125 a share. Something like that. It went up to about £3. Of course, the whole pipe potential of EV electric vehicles and this axial flux, technology they have, and then of course, the bear market started to bite, and everything started going down, and selling, baguette selling, and they've had so many options to go with. It seems to me, and the broker forecasts were nuts, ridiculous, going from nothing to 100 million in this couple of years. And now they've had to focus a bit, but they've just got that, like say, that deal.
With Avtech, which basically
and a commercial OEM as well. And to me, that's very significant.
Oh, it is, yeah. I mean, this is out in the Indian EV market to do effectively 3 and 4 wheelers, etc. But I mean, you look at any sort of like external research house, maybe Bain or whatever, and they reckon that the electric vehicle market out in India is going to grow to roughly get to about 100 billion by the end of the decade. So there's masses of opportunity, and if you do get onto one of these sort of like large sort of like platforms, whether it's for rickshaws or cars or scooters or whatever like that, I mean, it's the biggest sort of like 2 and 3 wheeler market by far in the world, because obviously everybody goes around on motorbikes. And the government is really sort of like, banging the table and moving towards sort of cleaner fuels and decarbonisation. I mean, you just got to go to Delhi and you can't even see the wall at the end of the, in your house, because it's so dirty. So there's a real big need and a real big push. And as you rightly point out, once you win those platform sort of like contracts, which they've done, so that's just one, and they've got another 10. Most of them in India to also do this sort of stuff. They've got that the Avtech gives them the e-transmission technology, which they're going to bolt on with effectively their e-motors and their e-inverters. And I mean, they're perfectly suited to do that.
Well, what's certain to me is that Avtech and the supply chain helping them out there, but it's almost like a co-promotional thing as well, isn't it? And
it is, yeah.
So Avtech, as reading here, is one of the largest independent manufacturers of powertrain and precision engineering products. And if you look at who they've worked with, literally Daimler, Ford, General Motors, Caterpillar, all these big companies. And yet they, and they've already got a deal, of course, with one of the largest OEMs in the light duty market. But Tony did say in that interview, so we expect more to come. And part of me thought there is more to come, isn't there?
There is, absolutely.
I know. And to me, this is now the start of commercialization. And the fact they've said, they've said that now that they've resized the business to take it to profitability, and they don't need to go back to the market. I think that was quite a significant last two. It's worth reading the RNS, the last two RNS they come out with, because I've been watching Saietta for a long time. And I'm glad I didn't get in earlier, because the bear market is really hard on stocks like this. But like I said, from here, that last Avtech announcement and that OEM deal, and the fact they're saying now they've right-sized the business, says a lot, I think. But the market obviously isn't missing it or doesn't care in the market in this. So I mean, that's where opportunities lie. If you've got patience, just keep watching. It'll maybe wait for another deal from India or whatever. Maybe I don't know what's going to move it, but they seem to be doing the right things, at the moment.
Yeah, and the other two big opportunities they've got, which is obviously the US heavy-duty truck and trailers with Conmet and the marine propel outboard motor, sort of opportunity. They're just on a different timeline. They're still going to come in 2024, 2025. And we're talking like, opportunities in addressable markets in the billions here. So, I mean, it's, again, there's significant opportunity everywhere. I think where Tony and the management team are, let's get this Indian opportunity nailed. Let's get it operational. Let's execute against the contract. First production deliveries are going to be in sort of September, October of this year. Once we get that, then, we'll scale up all the other ones as well. And who knows, but this could be another. We talked about Verici being a 10-bagger, but I wouldn't, in over 5-10 years, if they get this right, hey, there's absolutely every opportunity this could go up 10 times.
Yeah. No, I think so. It's definitely got potential there, and like I say, that market isn't getting any smaller. It's only getting larger, isn't it? So
well, it was to your credit. I remember you were one of the first to really sort of like raise the flag on EVs back in sort of 2020 and 2021, as in like a real opportunity. And it's a matter of sort of sifting through the ultimate winners and the losers. And if you're an investor like you and I, who are sort of more long-term orientated, it's sort of like then getting onto the coattails of ones you think who have got real longevity and are going to be the winners. And, both of those in long-term secular, markets, they've got a lot of opportunity.
Yeah, another couple of I'm just on the watch list. I've not done a huge amount of research on. Well, you mentioned OnCommune, that's there. Just there's opportunity there, and I think that will turn around. But also one is worth watching is Spectral MD. They do this deep view sort of burns AI technology, and it's very clever. They've been funded by BARDA, which is part of the American government, to the tune of hundreds of millions, and now they're going for FDA approval. I think, well, they're going to get it because it's been funded by the government pretty much. Yeah. But, I mean, their technology can identify whether burns need operating on there and then, and the burns will take or not, and the accuracy is like huge compared to what they use currently. And the broker forecasts on that are mad. And what is that at the moment? That's really a sub. It's pretty much 40 million, but I mean, broker forecast on that. Some of the revenues are in the triples. 200 million over the next 5 years, and so those kind of things. And again, it's been hammered, stuff like that. And there's lots of stuff out there, micro caps. Yeah. I think. I
mean, there's another one which is slightly bigger than a micro cap. It's sort of nearly 500 million pounds now. Which I own is FD Technologies. The old First Derivatives, and they came out with a really big contract just recently, which was basically extending their Microsoft Azure agreement. They've got this essentially. They've got a number of different parts of the sort of like the platform, etc. They've got three parts, but the really attractive one, the crown jewel, is the KX Insights business that basically is a picks and shovels real-time big data play for AI, because essentially you need your chips, your NVIDIA chips, to do all the processing. You've got all the data coming in, things like from 5G, from auto, from the financial markets and all this sort of stuff. It then goes into FD Technologies, who can then process it in real time with absolutely mass data, convert that from raw data into information, and then your AI systems, your learning software, you then interprets that information and makes decisions off the back of it. So these are basically like, let's say, the picks and shovels for AI. And what's happened is that they signed a contract with Microsoft about 12 months ago just for the capital markets, which is First Derivatives, meat and drink, bread and butter types, vertical, etc. But it's been going so well, they've decided to extend it to all the other industries. And it's a first this is a first real-time big data, sort of processing platform on Microsoft Azure, which says everything. It's their number one. It's their only one. Which actually works. So and I think the CEO of KX Insights, I mean, he basically said, this is enormous potential. We are really, really excited about this. And I think it's an absolutely brilliant business. And it's one of those things that's been sort of still hit by the market. I mean, it's still trading at sort of like, pretty cheap valuations. And it should do really, really well. And the other two parts of the business, one is the old First Derivatives business, which is effectively like an Accenture type of sort of like IT consultancy, sort of like systems business, but for really the capital markets, for all the sort of merchant banks and hedge funds, etc. And then they've got this effectively a marketing, advertising, lead creation business, it's called MRP, which is essentially is, you know, is obviously struggling in the digital marketing, but they've right sized it to make it EBITDA profitable. So they can basically, that's the sum of the parts, and I get some of the parts well over 25 quid. I know Investec are on about 30, but frankly, I actually think KX Insights is worth more than the entire share price at the moment, which is about at 17 quid. I mean, I just think KX Insights is just in the right place at the right time with the right technology. And frankly, nobody else has got it, that got that type of real-time data. And if you think about with 5G being implemented with Internet of Things, the amount of raw data created at the edge of the, you know, for things like Teslas or for auto drive, you know, for autonomous vehicles and all this, driver assisted, you've got all of the, you know, the smartphones, sorry, smart meters going in and all that kind of stuff. These guys need that expertise to be able to effectively improve the productivity, efficiency of the underlying networks or the underlying product. So they really are. I mean, I'm delighted I've got it, and I think this is going to go really well over the next sort of 2 or 3 years.
Cool. Yeah. But do you know what? I just put, if you want to do some homework and interviews, I just interviewed Matt Timmins from Fintel.
Oh yeah, and very good business that.
Yeah, and I don't know too much about it. I was looking at it as, you know, financial regulation, all that. They help companies and IFAs, wealth managers, all that. So a lot of regulation happening, pension providers. But yeah, very good. You know, 65% recurring revenues. And when I was doing a little bit of research to chat to him, I noticed the last RNS pretty much was directed dealings. And I thought, oh, that's interesting. Let's have a look at that.
Yes.
And normally they're just options stuff like that. And I thought, no, they haven't. He bought a chunk load of shares after the final results went out. He now owns just under 4%. He's been there since it started in 20 years ago. That says a lot. And they just bought a while back. They acquired De Facto a few years back, and they raised in debt. They've just cleared that debt off. They're profitable, paying a dividend, and you know, he said, well, simply I bought more because it's undervalued. He said, I think De Facto is worth the market cap of the company. We've got two parts of the business. You know, we've got Simply Biz and this, and so that's the kind of, you know, sensible business, underlooked on that side. And also another one. Actually,
just before you move off on that one, I'm with you. I mean, that's right on my stock watch list. Fintel.
I was going to say, I was talking to you when I thought you would like to look at that stock. Because,
no, I have, and I love it because
I
mean, if you look at the fact when you come to ask the question, obviously in terms of, you know, Matt Timmins buying the shares, and that's obviously good. But then you ask the question, how much upside is there? Well, I'll tell you how much upside there is. They're trading at roughly around about, I think it's sort of like 10 times EBITDA or something like that, not that much more. But these businesses go for 20 times EBITDA. In fact, its closest competitor was Euro Money, which went about 18 months ago at 22 times EBITDA. So, you know, I just would not, these are unique assets. And as you rightly point out, they've got a really good integrated model between providing all the services and the regulatory compliance and the fund manager and the fund information for IFAs to be able to improve their service. But equally, they've now got a really strong distribution as a service business for the product providers who, like your Avivas, who create products to make sure the products are better and better served and better fitted for, you know, basically for the IFA's clients. So yeah, I mean, they're winning. It's a really well integrated complementary business that makes really good, strong, you know, returns, high gross margins with recurring revenue streams. I mean, looks like a no-brainer to me.
Yeah. Well, you know what? Sometimes when you speak to people, you think, and so I thought, okay, I can have a closer look at this because you know, even just the way Matt's talking, is very confident this year, and everything's ticking up nicely, and it's going in line with expectation. But it's underlooked, and you realize if you want a predictable, stable business that's growing. And like I said, I think their cash conversion is 118%. You know, and then this is the kind of business you're looking at. You know, and yeah, but there we are. It's plenty out there, isn't there? You know, lots. And do you know what? In fact, I sort of broken notes on. I was chatting to going from sensible to sexy, crazy stocks who can do like multi bags.
Yeah,
that are out of favor. You know, if you look, if people, I mean, and a lot of people like, you know, oil and gas stocks and all that stuff. But to me, if you're going to play really potential, you know, breakneck upside with similar risk, but I think with you know, better reward is biotech and biopharma, because they're equally, you know, they can go like 100% to 200% a day sometimes. But if you look at, I mentioned before, Destiny's Pharma, to me, I think the shareholders of this are annoyed because they did a fundraising with a deal they did on their lead asset. Now, the lead asset's for CD for seal, but it means basically it's phase 2 assets completed that. So phase 3 is the final phase. That is now funded for by the partner. They got 1 million up front. They raised 7 million, and they've got a second asset. Now, the peak sales for that asset, their M3 asset, the lead asset, peak sales is around about $500 million. The next asset, which they're also in discussions on, is twice the market size of that, $1 billion peak sales. And I think they've got cash, they've got no risk now in their lead asset, and they're looking for a deal on the second, which they've mentioned they are in talks with. And I think it's that kind of stock, which they've got cash.
Agreed, yeah.
What's the risk here? What's the risk here? They've already they're not a one-trick pony. They've got a deal on their first asset. It's going to no financial burden for them for phase 3, and now they're going to phase 3 as well on the second asset. But they'll probably do a better deal now because it's a bigger, potential market cap, market opportunity. So things like that. I'm not saying go nuts on that, but if you, it's like the other ones we mentioned, macro caps. If you're going to take it,
special situations. I think I'm doing the same strategy as you. I think, we're aligned. You look at sort of like, oversold sort of big cap dividend paying stocks to provide you a bit of sort of financial ballast in your portfolio to allow you to sleep at night, but equally pick and choose sort of like smaller caps that you can actually, who have been battered, have got a good cash flow runway, great technology, high gross margins, that frankly, if you bought a basket of about sort of 10 of them, you've got a good chance of, 5 or 6 of them doing really, really well, multi-baggering, which that will give your portfolio huge amounts of alpha. So I'm with you. It's very much selective.
Yeah, exactly. I've got literally 5 bands in my portfolio: big caps, mid caps, small caps, and I got then micro caps and high potential stocks, and I vary my exposure to them accordingly. And at the moment in the big cap space, I've got it's Moneysupermarket, but in fact just hit the 12-month high today, which is quite nice. I haven't gone mad on it. I've got about 5% total exposure, but that's nice dividend paying stock. And once the energy market comes back into play, they're already growing anyway. But once that comes back into play, assuming upside, and in fact, I got that from you because you bought them, then you go back out. And I thought I'll have a look at them, and so I just kept them on the watch list. And sometimes you just have to do that, just keep things on the watch list for a while, but research them and just keep them on the watch list. So
no, my dad bought at the same. Well, my dad bought Moneysupermarket as well because he likes it, and I'm with you. I actually think they're going to get taken out with Mike because they're highly cash generative.
Your father? Did your father?
Oh yeah. See, no. He bought them at the same time as I did, so he's doing really well.
I know, exactly, yeah. And to me, like I said, close to 4% dividend, something like that, 4 or 5%. So it's and again, of course, as we go forward, on the Martin Lewis and all that stuff, and holidays and money, as we go forward, cost of living crisis, people are going to be looking around for better deals on credit cards or whatever. So, and then you got energy coming back in. So I think it's a very good stock to be in.
Yeah, and it's and also it's a platform, isn't it? Essentially, it's a portal. It's got high gross margins, and I think that's the key. Everybody puts different filters on that they look at and stuff like that. And my key ones are, the companies have got IPR. Look at the secular growth of the industry. Look at the valuation, and then look at the management team. Those four. But equally, I would say now, just as important on that, are the gross margins, i.e., has it got good operating leverage? Has it got good IP, and it can actually push through those price increases? And also, and I know it's already in your sort of like filter well through, is what is the cost of capital of this business, and is it going up? I.e., if it's got debt, then it's going to struggle refinancing that going forward, and you just don't want to be in a situation whereby you're forced to the markets to have to raise money, because essentially, let's just say, for instance, you raise cash, as a corporate in 2020 or 2021 at sort of 4 or 5%, you're probably looking at 10%, 12% now, and that will just destroy your share capital. So
I mean, one of the first things I look at now is literally go to the liabilities there on the balance sheet and see what loans they've got. No debt. Okay, I'll look further, because they've got a lot of it, and they're not interested. There's plenty of opportunities out there without debt, and you don't have to take it on. So
before we go though, what's your view on the banks? Because that's a difficult one, as in terms of sort of like because they haven't got that the debt sort of stuff. You tend to value it off net tangible assets, etc.
Yeah, well, I tell you what,
and they've been sold off.
Well, I tell you what, the best I ever did when I first started was during the great financial crisis when I went big on Lloyd's, and literally it was all or nothing. It was boom or bust.
No risk.
And I get literally put everything into it. I get average it down, and this is during the great financial crisis. And then the government.
That doesn't surprise me, Justin.
Yeah, but the government took over RBS, and oh my word, they don't want to take over Lloyd's, so they and then it didn't, and I thought, oh no, they own it was something like a third of the mortgage market. I thought, they can't take them over. Surely they can't go bust. And I was thinking about it, but literally it was a middle of the night, wake up sweating moment. But I did really well. I sort of I tripled my money on it or something ridiculous. But since then, since I've got to know a bit more and I've researched more, and I always confused by banks. I find them very hard financial statements. Like I said, assets and liabilities. I just find it very complex. And part of me thinks, apart from saying if they're at an all-time low, buy if it's a good bank like Barclays or Lloyd's. I'm not over them, but I think again they pay good dividends. They are good businesses. They're going through a tumultuous time, and the thing is, it's in tumultuous times you get bargains. That's it. It's not like saying, like for example, Housebuilders at the moment, there's going to be a tough outlook for them. I know, but when do you want to buy them then? When the outlook gets better, they'll have risen before then. You buy good businesses when literally it's very gloomy, and that's the bargain. That's a discount there, and then when it starts to get better, they will rise very quickly. And you think, I could have bought those at 50% cheaper, So so I think you've got to wait until there's a lot of worry out there. Buy a good bank. I don't know what's your preference in the banks, and then just hold it for a while, take the dividends.
Yeah, all I would say is I've got it's no touch for me at the moment. The banks, I just don't. The problem is at the moment is it's all a lot of it's sentiment driven, and the sentiment can destroy that particular bank. I mean, let's just be clear about it. About 10 years ago, or 15 years ago, Credit Suisse was trading at 70 francs, Swiss francs, I think it was, and now it traded, effectively got taken over at 0.75, I think, by UBS. And I would say, in terms of sort of like the balance sheets of these, they're black boxes. They're really difficult to get your head around, and they're hugely integrated with other financial institutions. So the biggest takeaway I got from what happened with UBS and Credit Suisse was that it needed to be pushed together, and it was done by the regulators. And if they hadn't have done it, it would have caused major distress with the other big systemically important banks, i.e. such that when it was announced on Sunday that UBS was going to buy it, who were the biggest two cheerleaders? It was the US Federal Reserve, because they are they look at all the FDIC, and the Bank of England and the CFA, who were really cheering it, because likes of Barclays has big exposure to Credit Suisse, and all the big merchant banks on New York also have major counterparty exposure to Credit Suisse. If that had gone belly up and started having to unwind all of those credit swap derivatives and all that sort of stuff, that would have been enormous, horrible. So all I would say is that you can say, yes, that I've gone through, I've fine-tuned combed all that balance sheet, but actually there's a shed load of derivatives which you don't even see. It's not even reported on the balance sheet, because they're not there. They're netted off at the year end or the quarter end or whatever it is. So you don't actually see it. It's only when you get a moment in time that you have to start unwinding it. I just think there are better risk reward profiles elsewhere. They're too dangerous, the big banks.
Well, I'm looking at it. This says everything to me. I said, exactly with SVB, the bonds they held, the prices went down, and the big hole in their balance sheets. And I see more of that kind of thing happening. But all I know is on Lloyd's chart here, I've got a price alert at 40 pence. That's it. And to me, they're at 47. So, and they're not that volatile a stock. So unless they hit that, I won't even be interested in them, because that's previous sort of support and also resistance. So, and if they break down below that, it's probably worth a look. But and then people start panicking and probably going further and start selling more. So it's not in, I don't know, just looking at the chart, it doesn't seem like it's mid-range. It's not high, it's not low. So that's the
and then it comes down to, when it comes down to your loan book, how much do you have to actually write those things off, or your effectively your assets you've got? Because I mean, essentially what happened during the banking crisis, effectively the pandemic, was that interest rates were reduced to zero, but actually everybody started saving, and the government just printed money. So they got deluged with masses and masses of deposits, so much deposits they didn't know what to do with, because no corporates were wanting to actually, basically to get any loans. They're paying off their debt, if anything. And on that basis, they had so much excess liquidity and deposits, they had to find a home for it. So instead of lending it out, they were actually investing it. And that's what happened with Silicon Bank. It put it into long-term treasury, got the mismatch. But all the banks had the same problem.
Put them in the safe bonds.
It is, yeah. But all the banks had the same problem. You know, put it into real estate. They put it into real estate. They put it into alternative assets. They put it into derivatives. I mean, one thing about Barclays, it's got this really old type of legacy debt pile, asset pile, that is, you know, I had a look at a couple of years back, and that's why I never bought them, because I couldn't get my head around what it is. So if you've got basically a bunch of big institutions with too much deposits, which is always nice to have, and they've got equity, they've got a liquidity mismatch or a timing mismatch, or they've put it into real estate or something like that that's coming off. At some point in time, you're going to have to market that kind of crap. And so what you're looking at, your net tangible book assets, is actually, you know, artificially high because they haven't written things down.
Well, it's funny. I was talking about Russ Mould about this, and he said, "Well, it's obviously the banks have been cheap for a while. We're now seeing there's reason for that." He said there's something smelly under the floorboards.
Yes,
and, you know, and that's it. So yeah, and like I said, Barclays. I think you're right. I mean, you know, it seems to be like there's more pain for the banks yet to come. You know, so now is not the time. When they are stupid bargain basement, maybe take a little position, but there we are. Marvelous stuff. Cheers for that, Paul.
Yeah, cheers, Justin. Bye.